is such a momentum trade. And really, I mean, we've gone from cocoa as a momentum trade to copper. And I do not see actually the fundamental support. You know, you look back at the last periods where copper really rallied, they had a great support for it. So it was the Chinese, basically build out of all the cities, all the infrastructure, 2006, 2007, 2021, copper was at all-time highs with the coming out of COVID, the huge build out of the housing market and globally reacceleration. China right now is really struggling with the housing market. The fundamental support there, I mean, you might be knocking down cities and have a lot of extra copper lying around. You can reuse it. But at the end of the day, right now, there's momentum trades all over markets. It has become a very quantitative algo market, and you've got to be careful of whipsaws. Yesterday, copper was down about 5% after a huge rally. We're watching that closely today because if it's a follow through on the downside, we think there's going to be more meaningful downside follow through there. But it's one of these things, you know, you could get whipsawed easy in some of these pockets of markets today.
Well, but I mean, the record high in copper, the record high in gold, the S&P is up another 12%. Nvidia has doubled. Are financial conditions really constraining here? Is the Fed doing its job to bring inflation down?
That's the nasty side effect. And it's a great point. You know, I mean, financial conditions look easy. They are of the easiest. You know, if you go to the Bloomberg terminal and take a look at it in history, high yield spreads are under 300 basis points. Historically, that is exceptionally easy. The dollar's the only kind of, I'd say, mix to that. It is relatively strong, but the VIX is, about 12. There is just a lack of risk being priced into markets today. And, I get it. NVIDIA, one stock, has great earnings. Some other big tech companies have had great earnings, but broadly, there's pockets of risk out there. And we think we just came off a mini economic cycle from the Fed pivot just 6 months ago, and we're seeing deceleration of economic growth in the U.S. at least. We're going to see if globally that happens. But actually, Europe, the PMIs the last couple of days that just came out this morning were pretty strong. So it's a mixed backdrop. It's challenging on the macro side. We're just trying to follow the earnings at the end of the day.
Matt, great having you on the show. Hope we get you back. Matt Miskin there is co-chief investment strategist over at John Hancock Investment Management. In a sense, my alma mater, as I interned for Tucker Anthony about 100 years ago, which was a John Hancock company. Coming up, fresh PMI data about to cross the wires. We are breaking those numbers for you next with Michael McKee. This is Bloomberg. got breaking U.S. PMI data coming in hot. Let's go to the Bloomberg International Economics and Policy correspondent with us again, Mike McKee, back in the studio. So, Mike, what do we see?
Well, the narrative that the economy is slowing down is not getting support from the S&P PMIs. The manufacturing PMI comes in at 50.9. It's the first time since 2022 it's been above 50. The services PMI 54.8 from 51.3, and the composite is 54.4 from 51.3. So improvement across the board with the PMIs. And of course, this follows on this morning's drop in jobless claims to 215,000. That is significantly down from the 230 some odd we saw a couple of weeks ago. That now looks like just a seasonal adjustment issue. So, Matt, we're still seeing strength in the economy, and the Fed's not going to move while we're seeing strength in the economy unless inflation comes down.
Or, I mean, if we continue to see strength in the economy and we continue to see inflation, supercore inflation trending higher, maybe they move to constrain financial conditions a little bit, because we are off to the races, it feels like, when you look at a lot of different data points.
Well, it's interesting because the Fed minutes of their May 1st meeting came out yesterday, and in those minutes they talked about questions about what effect the higher interest rates we've got are having on the economy. And some of them said, although monetary policy was seen as restrictive, many participants commented on their uncertainty about the degree of restrictiveness. Now, financial conditions don't necessarily reflect the real economy. They reflect what's going on Wall Street. But various participants mentioned a willingness to tighten policy further should risks to inflation materialize. Interesting. You'd think that would catch people's attention on Wall Street, but NVIDIA seems to be overcoming that. And you take a look at what's happened in the last 2 weeks, the odds of a rate hike on Wall Street, looking at SOFR futures, have come down. So at this point, the rate hike, even if the Fed was talking about it 3 weeks ago, doesn't seem to be a realistic possibility. The only question is, when does the Fed let us know that they might be willing to cut?
Do they have to cut eventually, Mike? I mean, we owe so much money that the carry costs are going to hurt if we have this higher for longer picture.
Well, if inflation didn't come down, they would keep things higher for longer, and they look at where we are and say, look at the economy. It's doing just fine with rates where we are. The only issue for them is if we still see inflation coming down, then you get real rates moving up. And so they would want to cut rates at some point. One of the big topics, though, of discussion is where do they go? How far do they cut? And the general impression they've been giving over the last couple of weeks is not as far as people might hope or think.
All right, Mike, thanks very much. Bloomberg's Michael McKee, International Policy and Economics Editor. For some more of the sector price action, let's get to Bloomberg's Simone Foxman standing by. Simone, what do we see?
Well, Matt, it's all about NVIDIA. That's what you've been saying all morning, and that's what we see when we look at our IMAP function. Infotech, the sector up highest this morning, up 1.5%. Only energy slightly in the green. Everything else we're looking at in the red. It's a reminder that NVIDIA is 18.6% of the S&P 500 Infotech Index. Notably, when we think about NVIDIA's size and impact, its market cap, which crossed $2.5 trillion at the open, is actually now larger than Tesla's and Amazon's combined, larger than Canada's entire GDP, our Terrell Holt points out. Also watching the Philadelphia Semiconductor Index, that's 14% NVIDIA. But also we're seeing trading in ASML, AMD, other semiconductor shares higher in sympathy with this. Coherent, also a name that we're seeing trade higher this morning, Matt.
Yeah, fascinating stuff. Market cap of NVIDIA right now, $2.53 trillion. Fewer than 14 of those make up the total federal debt of the U.S., which is $34.5 trillion. Simone, thanks very much for joining us. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. right, we are just about 25 minutes into the trade on this Thursday, looking at an S&P 500 that's actually unchanged right now. So even with the blowout NVIDIA earnings and the rise in those shares, we're not driven to a much higher record, a higher record on the S&P 500 at 5307. The NASDAQ, of course, gaining a bit more ground as the tech stocks are really behind that push. The NASDAQ 100 right now at an all-time record high. And the Russell 2000, the small caps, are actually down about 0.5% right now. Take a look at the two most interesting movers, I think, today. NVIDIA is one of them, obviously up more than 8% right now, worth more than $2.5 trillion, as Simone Foxman was just telling us. Right now, over $1,000 a share. And, of course, we're going to get a 10-for-1 split there that'll make it maybe more palatable to the retail investor. And then Live Nation right now off 1.6% after people familiar say the Justice Department is going to try and break up that unrivaled ticket seller in terms of it being a monopoly. I guess there could be a debate on that, although I haven't used anything else to buy tickets other than Live Nation or StubHub, which interestingly seems to get the tickets just as fast as Live Nation can put them up for sale. The S&P 500, again, little changed, even as we see this big rally in NVIDIA shares. Take a look at what's going on throughout the week. No home sales data coming out at the top of the hour. Plus, more Fed speak from Atlanta Fed President Raphael Bostic. And tomorrow we're going to get UMich Consumer Sentiment Survey. This is Bloomberg.
We are 30 minutes into the U.S. trading day on this Thursday, May 23rd. Here are the top stories we're following. NVIDIA delivers a beat-and-raise quarter, projecting second quarter revenue of $28 billion as AI spending continues to benefit the chipmaker. That's breathed fresh life into the S&P 500's record run. Meanwhile, e.l.f. Beauty beats estimates, but the cosmetic company delivered what Wall Street is calling conservative guidance for the fiscal year. We'll discuss the results and the state of consumer spending with e.l.f. Beauty CFO Mandy Fields, and an exclusive conversation with Anna Paglia in her first TV interview as State Street Global Advisors Chief Business Officer. We'll get her views on the asset management industry, an uptick in self-directed investing, and of course, how ETFs fit into retirement. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets right now, and there is a lot of green on this screen behind me. The S&P 500 currently up just 0.1%, but hitting an intraday record high, and all of that strength is really coming, of course, from the tech sector, and specifically from NVIDIA, which we will get into. But you take a look at the big tech index, the NASDAQ 100 right now, higher by about 0.5%, I would call that. And then you take a look at the Philadelphia Semiconductor Index. It's an even better story. The stock's currently higher by about 1.3%. And again, it's all about NVIDIA blowing past expectations. The chip makers' results really delivering, showing growth in artificial intelligence is only just beginning. Ed Ludlow of Bloomberg Technology joins us now with the details. And you and I were just on with Matt Miller about 30 minutes ago talking about hyperscalers and the fact that NVIDIA's customer base is starting to expand beyond just those hyperscalers. So walk us through that a little bit more.
Yes, the basic story is that all of the investment, all of the big spending on AI infrastructure has not only not slowed down, but it's growing to new areas. In really simple terms, NVIDIA makes chips called GPUs, or otherwise known as AI accelerators, that can handle lots of data processes in parallel. But the first iteration was just a very small number of players. NVIDIA would sell the GPUs to what we call hyperscalers, but the cloud providers, AWS, Microsoft Azure, Google Cloud, who run very big data centers. And so that was a question, like, when does it move beyond that? And in the outlook for the fiscal second quarter, $28 billion plus or minus 2%, which exceeded expectations, but also the commentary, AI's moved to the next wave where basically smaller companies are buying gear from NVIDIA to train models. And that's an interesting development.
And let's talk a little bit about, of course, the stock split as well, that 10-for-1 stock split. I think that surprised a lot of people. Stock splits, as of course we love to say, they don't actually impact the fundamentals of a company's business. So what's the logic behind this stock split for NVIDIA?
Yeah, a stock split is not dilutive, but during the earnings call, not only was I on the top live blog on the Bloomberg terminal, but I was looking on X, I was looking on Reddit, I was looking on Google real-time search trends, and NVIDIA was top of all three. There's really intense retail interest in the NVIDIA AI story, but I don't know if you guys can quickly pull up the shares. There they are. You're trading at $1,000 a share. So a 10-for-1 split effective June 7th lowers the barrier to entry. It gives, I guess, more everyday investors a chance to be a stakeholder in what's happening in AI. And I think Jensen Huang's quite conscious of that. Like, when I've spoken to him, I get the sense that he wants people to feel involved in what's happening beyond the giants technology companies that they do business with.
All right, there you have it. Bloomberg's Ed Ludlow. Thank you so much. Of course, you can catch Ed coming up next hour on Bloomberg Technology. I imagine they're going to talk about NVIDIA with shares higher 108% just year to date. Let's zoom out now and get to the broader markets. We're going to do that with Sarah Kuntz. She is a Clio Capital founder. And Sarah, I'm taking a look at your notes, and you write that you like NVIDIA, but you don't love NVIDIA. Is that still the case?
It is the case. It's a good company. They design interesting chips. The problem is that they're not the only player in the game. And to some extent, the thing that makes them such an interesting name, I think, is going to be the thing that drives a slowdown there, which is that their margins are crazy high. And that is great if you've been riding it up. But as time goes on, we're seeing names like Apple, which we sometimes forget. Apple's a huge chip designer in its own right, and they have been focusing a lot more more on designing AI chips, which at scale means they're probably going to be buying less from NVIDIA. You know, we saw that Amazon is slowing down their ordering, and they say it's a good thing, right? That everything is amicable. They're slowing down their ordering of the Grace Hopper chip because they want to wait for the Grace Blackwell chip. But either way, a slowdown in orders isn't necessarily what you want to see. And so I think that NVIDIA is a good, solid company that has turned into almost a bit of a meme stock in the sense of sort of the adoration and the excitement around a company that just isn't the only game in town.
Well, of course, as Ed Ludlow just told us, when it comes to the retail interest, it is just off the charts. But someone could push back to what you're saying about NVIDIA and say that they're really the only game in town. Actually, you think about how really established their lead is on the rest of the field. You think about Intel, for example, and how NVIDIA has just lapped them. And that would be the pushback. I mean, how do you think about that and just how big that head start NVIDIA has?
Well, I think the real pushback is the stock price, right? But, you know, the reality is that they've had this amazing run, but at the same time, chip design isn't quite as linear as we might think. And so, you know, certainly NVIDIA does have this advantage because other people weren't focused on these chips because they weren't making chips for gaming, right? Which is really where NVIDIA had been over the last few years until this AI run. And so, you know, as people are looking around at that, as the Intels of the world are saying, actually, this is a much bigger business than just gaming design. We do want to go make those chips. They have the capabilities. They have the teams. They've been hiring engineers who can do this for years. They just haven't been focused on it. And so I do think that NVIDIA's had a head start. I don't think that long term it stays that way. And so this isn't a quarter by quarter call, which I know the street, you know, that's what you want to hear, right? What do you trade today? But I do think in the next year and certainly in the next 2 years, a lot of this NVIDIA advantage is really going to go away. And they might pull another rabbit out of the hat. But if they continue the way that they are, the reality is that people are designing more chips in-house, the big Mag 7 companies, and just a lot of these other companies are likely to catch up.
And point taken on valuations. Of course, you could argue that by certain metrics, NVIDIA still looks cheap, but then you take a look at just how far shares have come. Just in the past couple months, it is really breathtaking. Let's talk about a name that you do like, though. Taiwan Semiconductor, that caught my eye since you think about some of the geopolitical tensions, questions, potential issues around that name. How do you square that with the company's fundamentals?
Yeah, I mean, I think one, you know, you see that they are working to move manufacturing, to other countries so that they're not solely tied to Taiwan. There was news out the other day that they do have the capabilities to effectively turn off the factory in Taiwan if there is, an invasion. And the other reality is that, as we're seeing in Russia, you know, it is hard to prosecute a war at any scale, and certainly China loves to saber rattle. But, you know, it's hard to do that at any real scale without getting a lot of global involvement you don't necessarily want. And so while that remains something to keep an eye on, I think if that does happen, we have a lot more problems than just Taiwan Semiconductor. And the reality is, in the short term, they're the people actually making these chips, right? So NVIDIA designs chips. Apple can also design their own chips. A lot of people can design them, but at the end of the day, there are very few places to actually manufacture them. Taiwan Semiconductor is one of them. And while it is certainly getting a bit more expensive, I think it's a company that is broadly undervalued in the market, given its role for everybody designing chips and actually producing them.
And we're talking about AI in the context of the public markets right now, but I'd love to go into your portfolio and talk about some of the holdings you have there in the private markets where, of course, there's been so much buzz around. Let's talk about Grok, for example. It's a name that, when you think about buzz, it certainly has it.
Yeah, and it's Grok with a Q. It was the first Grok, right? Elon copied as he does. But, you know, it's a company that's just really fascinating because they are focused on language processing units. You know, they spun out of Google years ago because, again, the big companies have a lot of this tech talent in there. And I've been lucky enough to back them since 2018. And so they started with a focus on kind of more self-driving cars. And now it's really, you know, an AI-focused company. And what what they can do around inference with LPUs, language processing units versus GPUs is really, really interesting. It's faster, it's cheaper, and it's where the industry seems to really be going. And so that's definitely a name that I'm excited about, but also a name that I'm hearing a lot of excitement about outside of just my portfolio.
So Grok with a Q, everyone write that down. Before I let you go, Sarah, we don't have much time left, but I want to talk a little bit more about private markets, because the narrative that's out there is that you have companies staying private for longer, and you're obviously seeing that in the IPO volume. When you're evaluating the private markets, is that something you're seeing as well? Is there just more opportunities than maybe there have been in the past with companies staying private?
I think for a long time there were more opportunities to stay private. Unfortunately, now I think there just aren't many opportunities to go public. These companies are going public. Their stock price tends to dip and not sort of soar back up. And then unfortunately, the M&A market has just gotten incredibly tough, because when the big companies try to buy, Lena Khan tends to say no. And so, I think that we will have a private for longer narrative. I think investors are ready and able to fund that, even if we're not quite as enthusiastic about it as we were a few years ago when the Ubers of the world were staying public forever or private forever.
All right, Sarah, always enjoy speaking with you. Hope you'll come back soon. Our thanks, of course, to Sarah Kuntz of Clio Capital. And let's take a look now. It's moving underneath these markets. We're going to do that with Bloomberg's Emily Grafeo sitting to my left. What do you have?
I'm looking at VF Corp. That stock is falling as much as 11% to the lowest intraday level since 2009. This is the parent company of Vans sneakers, North Face. And I got to say, I walk around the streets of New York City, don't see a lot of Vans. I see a lot of Adidas, Sambas, Nike, but that classic Vans sneaker is falling out of trend, and you can see that in the parent company's earnings. The EPS and sales missed estimates, 7th consecutive quarter of falling sales, and the Vans revenue fell 26% year over year, and that stock is already down 34% year to date, and it seems like this earnings this morning is not helping the company.
Yeah, painful story that is just getting worse there. Let's talk about Ralph Lauren. I thought this one was interesting because you take a look at their numbers, they did great, but it seems like it's all coming down to that forecast.
That's right. The 2025 forecast for revenue fell short of estimates. The retailer says that they see revenue in constant currency growing 2% to 3%. The average analyst estimate was 4.4%, so not a large miss, Katie, but a miss nonetheless. That stock, though, is outperforming the S&P 500 year to date, but falling a little bit in the pre-market. Bloomberg Intelligence did say that that forecast might be a little bit low, so perhaps leaving room for a surprise for Ralph Lauren in the future.
Yeah, it could be an under-promise, over-deliver type of situation. Let's talk about spin-offs. So hot right now.
So hot. We're seeing a three-way spin-off, which you don't see that much, but DuPont is planning to split their company into 3 publicly traded units. They're going to be separating their electronic and water unit, and then the remaining company is going to be more narrowly focused on industries like biopharma and medical devices. The process is going to take about 2 years, and this follows a growing list of industrial conglomerates separating. Think J&J, General Electric. Overall, although the stock is pairing gains, the analysts on the street seem to be cheering the split. We had Morgan Stanley saying this was a logical decision, KeyBank strongly supporting the move, and then Melius Research saying that the assets together didn't play well, but perhaps separately they look interesting. And that bodes well with the year-to-date price. The stock is falling about 2%, so perhaps this split will boost that.
Break them apart, let them shine. Bloomberg's Emily Grafeo, thank you so much. Now coming up, e.l.f. Beauty posting its first billion-dollar year as sales spike in its latest quarter. We're going to get the highlights from Mandy Fields. She is e.l.f. Beauty CFO next. This is Bloomberg. e.l.f. Beauty crushing earnings estimates, surpassing $1 billion in sales for the very first time. But the makeup brand also issuing weaker than expected guidance. Here with more details is Mandy Field. She is e.l.f. Beauty CFO, and shares are absolutely flying today. I see them up about 16% on my screen. Let's talk about the guidance, though, because you forecast EPS between $3.20 to $3.25 in fiscal 2025. Analysts had been expecting $3.56, so a bit of a disappointment there. But I mean, looking through the notes and of course your past quarters, this seems pretty much like it's a strategy for you guys to basically underpromise. Talk us through that, and why give conservative guidance going ahead?
Well, I am very pleased with where we have landed from a guidance standpoint. We just delivered our first $1 billion year, as you said, 77% net sales growth. So really this guidance is building strength upon strength. We have outlooks 20 to 22% net sales growth, 21 to 23% adjusted EBITDA growth for the year. And so, as I said, strength on strength is how we see it. And we are being prudent with our guidance, as we have been, very balanced in our approach, in fact, and we take it one quarter at a time.
One quarter at a time. But when you look ahead to this coming quarter, of course, and the quarter that we're in, what are you seeing in terms of demand? Obviously, so far, like you said, strength on strength, but a lot of fears across really the retail industry about that consumers starting to pull back, maybe spending less on discretionary items. What do you see from your vantage point?
We continue to see a lot of momentum behind the e.l.f. brand. If you think about where we are from a price point standpoint, we're about $6.50 on average. That compares to others in the mass beauty space that are $9.50. And, you know, when you get into prestige, it's over $20 on average. And so we are still a standout from a value proposition, and then you pair that with the holy grail innovation that we're able to offer and our incredible marketing and digital engine, and we continue to see our community coming back and buying more of e.l.f.
Well, you mentioned your value, and that's something that I've been wondering about. When you think about e.l.f. winning market share, is that because of your pricing, of that value that you offer? Would you chalk it up to other factors? And I think about your marketing, for example, and it seems like Gen Z also has a connection with this brand in particular.
Absolutely. And so we are celebrating not only our 21st consecutive quarter of sales growth, but also our 21st consecutive quarter of market share gains. We gained over 300 basis points of market share on the year, 325 basis points in the quarter. And so we continue to gain share. In fact, this last 12 weeks, we became the #1 unit share brand. And so all of our growth has really been volume led, which we're very pleased with. And in terms of kind of what's driving that, it really comes down to those three things I mentioned: our value proposition paired with that holy grail strategy. And so when we think about the products that e.l.f. offers, you could pick something up in prestige maybe for $50. e.l.f. is able to bring it to life, and even better at $10. And so we have a great holy grail strategy that we continue to build upon year after year. And then our marketing and digital engine is where the fun happens. We have done a lot of collaborations. Most recently, we did a collaboration with Liquid Death, our corpse paint that we were able to put out there for our community. And they're there for it. They're there for all of the fun things that we do with this brand.
I'm sorry, did you say Liquid Death as in the water company?
That's right. That's right.
There
we
you
had
go.
a little casket with makeup in it that you could have your fun with.
There you go. And you think about strong advertising campaigns. Liquid Death obviously charts highly there too. I do want to talk about a little bit more about demand and whether you're seeing any differences among regions, especially when it comes to different types of products as well.
Not so much from a regional standpoint, but I would say that we are offering products that our community is asking for. A great example of that is our bronzing drops. We just launched those maybe a few months ago. They'll go out into retail this summer, and it has quickly become the best-selling item on our e-commerce site. And if you think about how those came to be, that was our community asking us, when are you going to do this, e.l.f.? We know you can do it. We know you can do it better. And we were able to provide those for our community.
And I also want to talk about the relationship with Sephora, because you take a look at some recent announcement. e.l.f. is going to be in Sephora in Mexico in the fall. That is their first partnership there that you have with them. Could we ultimately see e.l.f. in Sephora stores in the U.S., or what's the potential timeline there?
So we're super excited to be going into Sephora in Mexico. That will be, as you said, our first partnership with Sephora on the e.l.f. brand, which is very exciting. So we're going to take it one market at a time. We love that we're able to go into Mexico. I think from a U.S. standpoint, Sephora is more focused on prestige, and we do lean more mass. And so not as likely that we'll show up in U.S. Sephora stores, but you can definitely check us out in Mexico this fall.
All right, there you go. And I mean, when it comes to expansion, I mean, when you think about regions that you would like to expand in, obviously Mexico being an example, what else is on your list for where you would like to go?
Well, international expansion is a key white space opportunity for us. Only about 16% of our sales come from outside of the U.S., and that compares to over 70% for other beauty peers. And so we know that there is a huge opportunity for us outside of the U.S. Our international business has grown phenomenally. It's over 115% growth we saw in this last year in our international markets. And today we're mainly in the UK and Canada. So that leaves the rest of the world really open to us. And so we're excited for the international expansion that we will continue to talk about. We talked about Sephora Mexico. We just launched in Douglas in Italy back in the fall, Etos in the Netherlands this spring, and we'll continue to kind of find out which market we're going to go into next. But that is a real white space opportunity for us.
All right, Mandy, really great to catch up with you. Know it's early on your end, so appreciate your time this morning. Our thanks to Mandy Fields. She is the CFO of e.l.f. Beauty, and I will point out shares currently up by about 15%. That's the best day for the stock in about a year. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Americans are putting down the pints and packing up the bowl. A new study out from Carnegie Mellon today says that more Americans smoke marijuana daily than drink alcohol on a daily basis. That is the first time that's happened in 30 years, of course, reflecting changes in public policy. Next up, we have BJ's Wholesale Club delivering underwhelming first quarter results. The membership-based warehouse club says that comparable sales grew slightly, but it left its outlook for the year unchanged. And finally, we have Hasbro breaking out the toy chest on an upgrade from JP Morgan. The firm says that the toy industry is positioned for impressive growth this year despite a shortened holiday season. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, you take a look at markets right now. The S&P 500 pretty much unchanged on the day. As you can see, little movement there, even though you have NVIDIA shares up by 9%. That is not making much of a dent in the S&P 500. You take a look right now, 410 names in that index are lower right now. So NVIDIA doing a lot of heavy lifting, but just not enough when you have that volume of down names. Meanwhile, you take a look at the NASDAQ 100, higher by about 0.5%. And of course, the CHIPS index, the Philadelphia Semiconductor Index, higher by about 1.5%. Now coming up, a Bloomberg exclusive. We'll hear from Anna Paglia. She is State Street Global Advisor's Chief Business Officer in her first interview since taking the post. This is Bloomberg.
Great questions.
Anna Paglia made her name as the global head of ETFs over at Invesco, launching over 100 new ETFs across the U.S., Canada, and Europe. But today, she's the Chief Business Officer at State Street Global Advisors, a role that she started in just on February 1st. And I'm pleased to say that she joins us in her first TV interview in her new role right now in a Bloomberg exclusive. Anna, it's great to see you, of course.
Good to see you. Thank you for having me, Kathy.
Let's talk about your title, Chief Business Officer. I have to admit, I hadn't heard it before, so just lay us out what that exactly means and what your role looks like.
Sure. So
I'm not surprised to hear that you have not heard about it before because it is new. And it is one of the things that attracted me to State Street Global Advisors. The CEO of Global Advisors, Yixin Hang, she has a very dynamic view and vision for leadership. So she created this role, which is really new in the industry. And my job really spans across the different business lines at Global Advisors. And I'm responsible for building a growth plan and executing on this growth plan across different business lines and bringing together all the stakeholders, investment, distribution, marketing. So it's really new, it's really dynamic, it's really exciting, and I'm having a great time so far.
Well, let's talk about that growth plan a little bit more. Of course, you have 3 or so months under your belt. When you think about the growth plan, what is towards the top of your priority list?
The top of the priority list is innovation, reigniting and accelerating the innovation engine at Global Advisors. Obviously, the company is very known in the industry for the flagship capabilities, SPY, GLD, sector, spiders, to name a few. But the industry is changing, so keeping up with the change in the industry, keeping up with the trends, continue to maximize the flagship capabilities, but also building on top of that. That's top of mind.
So when you say building on top of that and really maximizing innovation, are you talking about the product lineup, new products, or are you talking about distribution or other areas of the business?
Well, it's all of the above. Products are essential. I mean, if you don't have products, if you cannot show innovation when it comes to the content, you really don't have a great conversation with your clients. But innovation goes outside of products. It's about how you become this essential partner for your clients, this very important partner that they go to. For us older people, it's like top of the Rolodex. If for people who know what a Rolodex is.
I've heard of it.
You heard of it.
Yeah.
I used it.
Yeah.
So, and that is about technology, is about solutions, is about, we are looking at how to use ETFs as building blocks in model portfolios, but also in retirement, in other sectors of the market, in other segments of the market where our clients are operating, and it's important to provide a full package of solutions.
Well, when it comes to product innovation, I think I have to ask you about Bitcoin ETFs, because if you think about your time at Invesco, you were really one of the driving forces behind Invesco's spot Bitcoin ETF. And it was always curious to me that State Street didn't have a filing, given that you are home to GLD, which is, of course, the biggest spot commodity ETF. I know you can't say much, but are there any plans? Is that a decision that you're thinking about to put forth an application?
Well, I really cannot talk about plans, but I can tell you a couple of things which are obvious because you and I have known each other. Am I a believer in digital assets? Yes. Am I excited about bringing Bitcoin number 13 to the U.S. market, or number 12? I don't even know how many are now out there. No, that's not exciting to me. What's exciting to me at this point is thinking about digital assets versions 2.0. What does it look like, and how do you integrate Bitcoin, other currencies, the blockchain technology into more solution-oriented products that are not just a single currency? So that 2.0 is really what's exciting right now.
So maybe, of course, building on top of that, but I definitely take your point that being the 12th spot Bitcoin ETF issuer, I've heard before, if you're not first, you're last. Maybe that's an instance of that. But I also really want to talk to you about the cash business. Of course, in the notes you sent us over, you think about State Street Global Advisors cash business has grown 52% from $349 billion in 2019 to $529 billion in 2023. I mean, that is just incredible growth. Where is the money coming from? Is that coming from bank deposits? Is it coming out of the risk asset, the equity markets, for example?
Well, it's a combination of all of the above. The cash business is not a business that peaks and then goes away. So even before this interest rate hikes, that business was healthy, so $250 billion in assets. The interest rate environment and the macro market environment has now catapulted that to over $500 billion, $500 billion. And that comes from institutional investors putting their cash to work. I mean, right now with these high interest rates, cash can work for you. But also other investors that are really immune from interest rate hikes and are using money market funds as a good way to put their cash to work. So there are definitely market dynamics that make this conversation and this part of the business very important today. But this is an organic growth that we continue to see despite and regardless of interest rate market environments.
And I mean, you think about $500 billion in money market funds, which are cheap in the grand scheme of life, but expensive compared to cash like ETFs, for example. How meaningful has that growth been in terms of the contribution to State Street Global Advisors' overall revenue picture?
Well, you have to look at the entire business of State Street Global Advisors. The business has now crossed the $4 trillion, which is like phenomenal growth, $4.3 trillion that is cut across cash, $500 billion, retirement, almost $1 trillion, and everything else is a mix of institutional, customized mandates and ETFs. So the revenue mix has been pretty healthy, and it's really about not focusing on one or the other, but working across that entire spectrum, that entire barbell, that is working really well for global advisors today.
And I do want to get to retirement, but before we leave behind money market funds, you think about your market share right now. It's increased to 5.9% at the end of 2023. Do you have projections or a target of where you would like that share to go?
We don't have targets for the market share. We really look at the growth. That business is growing, so we will work and try to continue to accelerate that growth. And obviously, if we do it well, which we will, that will translate also in increasing market share. But we don't have a defined target right now.
Okay, so let's also talk about retirement. Since you and I have spoken about before, when you think about ETFs, they don't fit into traditional retirement accounts. I'm thinking 401ks, for example, don't incorporate ETFs. Do you see that changing, or how can ETFs actually fit into an investor's retirement planning?
We are working really hard with regulators, with investors, with plan sponsors to make sure that ETFs find a way into retirement, because 401k plans don't buy ETFs for all the reasons that are very known to us, is technology, is regulation, but we believe that these things are going to converge at some point. And ETFs, just like mutual funds, are used in other parts of the retirement industry, like, for example, IRAs. And we are really working to build an ecosystem where ETFs can find their way into 401k plans as well. We do have technology. We do have some solution-oriented technologies and portfolios that put together target date funds and annuities to follow an investor, to follow a retired person get into retirement and going through retirement. And we really believe that there is room for ETFs in that conversation.
That's interesting. And before I let you go, just to sort of crystallize that point, so you do see a future where ETFs could be in 401ks, for example?
I definitely see that. I mean, Katie, I'm an ETF lady, and I do believe in the strength of the wrapper. So I do believe they will play a fantastic role in 401k and retirement plans.
Well, from one ETF lady to another, it's really great to see you. Hope to continue this conversation soon.
For
Our
sure.
thanks, of course, to Anna Paglia of State Street Global Advisors. Let's get a check on the broader markets right now. We're going to do that with Bloomberg's Natalia Konijevich.
Hi, Katie. So the S&P 500 is relatively flat today. It's trading around 5300. We see that there was an accelerating in business activity here in the U.S. Inflation also remains elevated, and yesterday's FOMC meetings showed that Fed officials are discussing higher for longer interest rates. The Nasdaq is doing slightly better. We see that it's up by 0.7%. Crude is moving higher as well. It's now trading slightly above its 3-month low, but this is also can be due to a slight decline in the US dollar. WTI is currently trading at $77 a barrel. And of course, due to this economic data and yesterday's FOMC minutes, we see that yields are moving higher. 10-year yield is now currently trading at 4.9%. Let's flip up the board and talk about individual stocks. Of course, NVIDIA is the most important. It's now up by 9.7%. Of course, results were better. Forecast was strong. The company also announced a stock split, which was really encouraging for retail traders specifically. We will get back to this in a moment. Then Morgan Stanley is down by 1%. That's on news that James Gorman is stepping down at the end of this year. Live Nation is moving lower, 4.9%. That's on news that Department of Justice is reportedly set to sue the company over some antitrust concerns. And VF Corp is also moving lower, almost 4%. That's after disappointing results, and some analysts downgraded the stock. Let's take a quick look at NVIDIA five-year chart. This is why this stock split is so important. So in 2021, when the company announced a stock split, the stock gained about 20% between an announcement and the effective date. And now some traders are saying that this stock split can accelerate activity from retail traders between, again, now and this effective date, which is 2 weeks from today, Katie.
All right, Natalia, thank you so much for that roundup. Now, coming up, how to ease China's property crisis. We'll explore with Henry McVeigh. He is KKR head of global macro, balance sheet, and risk. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And today, we're looking at China's post-COVID economy. Wall Street Week's David Weston spoke with Henry McVeigh. He is KKR's head of global macro, balance sheet, and risk about what he's learned from his recent trip to China.
The economy is bottoming. We heard a couple of different data points, I think, from companies in the logistics business that are seeing the U.S. consumer pick up a bit. So that was a positive. And I do think things have bottomed also in Europe, and there's a little bit more demand. But overall, it's still a pretty sluggish economy post-COVID with very low inflation.
And the growth that is there is not evenly distributed. There are some areas growing much more than others, as I understand it.
Yeah, we've spent a lot of time. I've actually been to China 4 times in the last 5 quarters. So I'll give you how I think the evolution of the economy is changing. Really, a lot of people focus on fixed investment. They focus on exports. I think the Chinese government is really repositioning the economy towards a couple of different things. One is this whole idea of digitalization, particularly as it relates to the industrial sector. They're trying to automate that sector to be more effective and more competitive globally. In the past, I think a lot of people thought about China in terms of e-commerce, Alibaba, domestic consumption. The focus right now from the government really is on industrial automation. China today actually has about half the world's robots on the industrial side, which is an amazing statistic. The second big driver is around the green effort, and they're trying to really dominate batteries, EVs, and solar panels and that, and they're trying to export some of that globally. So those are really the growth drivers. The offset, which is still problematic, is around housing, and our estimate is they have somewhere between kind of 20 and 30 million too many homes, and so they're trying to clean that out right now, but that's a disinflationary force, and it clearly has an impact on domestic psychology as well.
Some of what China is investing in the green transition has gotten the attention of places like the United States and Europe, whether it's solar panels or batteries or EVs, because there's a concern of a build of overcapacity.
Yeah.
Do you see overcapacity, and what does that do to margins?
I think what's going to happen around the world right now is that industries such as autos are going to become of national interest. We've already seen that in technology, could expand into other sectors. So there's definitely going to be sensitivity. You saw President Biden talked about increasing the tariffs there. Europe, I think, is going to do a similar type of strategy. So you can have capacity. The question is where can that capacity go? I think probably if you're China, you'll see more of it go into places such as Latin America, other places, maybe Eastern Europe, where they have partners that maybe there's increasing kind of bilateral trade. That doesn't seem to be the case in the U.S. and Europe right now.
What about the animal spirits, as it were? I mean, because there are a lot of reports that both individual people and corporations may be sitting on their money a little bit because they don't have the confidence.
Yeah, you've seen about a 300 basis point increase in the savings rate. China has a high savings rate to start. It's about 28% normally. It's upwards of kind of 31, 32%. So we estimate if